Here we are on BiTV with Khalil Hankach, CEO of Inovalis, a global player in real estate investment and management in Europe. Khalil, thanks to be our guest today.
Thank you. Good morning.
What is your perception of the European real estate market as an manager?
So the real estate market's gone through some troubling times recently with inflation going up. This has driven interest rates up from central banks. We are currently looking at US interest rates at around 4.5% going up to 5.5. European interest rates at 2.5 expected to go up to 3.75. This increase in interest rates coupled with perspectives of recession have slowed down the real estate market in Europe and the world. In France, for example, we saw a fourth quarter which was very, very low compared to historical quarters. And so we are currently in a situation where sellers and buyers are at two different spectrums, a huge gap in pricing between the expectations of the sellers and the anticipation of the buyers. Hopefully, there will be a few triggers, mainly investors continuing to collect money by year end will feel the obligation to buy and therefore become a little bit more flexible on pricing. Sellers who have maturities on their loans, which will start arriving and then also feel a little bit of incentive to review their price levels. And finally, hopefully, by the end of the year, we should see a stop in increase in interest rates, which should lead to a lower cost of debt and therefore a more agreeable market where buyers and sellers will find a price consensus. The main takeout from what we're going to see, I think, in the next cycle is that the cheap money is no longer here, the cheap debt is no longer here, and investors have to look for asset managers, investment managers with real estate experience that can drag value from real estate.
Okay, and could you give us a more specific overview of the office sector and its future?
Sure. So the office sector with COVID and working from home has had a bit of difficulty over the past few years. There's a recent study that came out in the Wall Street Journal from GLL that showed that the different countries shouldn't be judged the same way. The US, for instance, has an occupancy rate of 40 to 60%, whereas Europe has an occupancy rate of 70 to 90%. So offices have been more resilient in Europe than they've been in the US. If you take on top of that the fact that in Europe rents are indexed to inflation, it's a great investment product for inflation-proof security. It's true that the office sector has had to readapt because tenants are looking for different office space than they used to before. They want more communal, more homely kind of office space where employees can interact more freely. And landlords are looking are willing to pay premium, when the offices have labels such as HQE, BREEAM, LEED, better, more efficient buildings. So in my opinion, offices still have a good future ahead of them as long as it's the right product, right location.
And let's talk about the future. What opportunities do you imagine for the next years?
So, first and foremost, Inovalis will be Inovalis Advenis Group. It's 350 professionals, mostly in real estate. We work in France, in Germany, in Spain. We're going to be managing our real estate because our current investors is our primary objective. We have billions under management. But we also see a good future for core plus assets, office mainly, but other products also with a bit of price correction, they could become more interesting. We really enjoy, and it's part of our DNA, to do value add. So we're looking more and more at value add to green opportunities. And finally, there's the listed real estate versus the physical real estate. In the listed real estate, we've seen a much larger drop in prices than in the physical real estate. And so we're hoping to launch a fund of REIT. And we're also looking at individual, smaller REITs to take them private.
Okay, so you're optimistic.
Very optimistic on the future.
Thank you, Khalil, for this insight.
You're welcome. Thank you very much.
Thank you, and see you soon.